It happened again. Silver didn't break $40 because retail finally woke up. Silver didn't break $40 because a single headline dropped overnight. Silver didn't break $40 because some analyst on television finally admitted what the physical market has been screaming for 18 months. Silver broke $42 because a level that had capped this metal for years just gave way. A level every serious trader had marked on their chart in red. A level the shorts were defending with everything they had. And when it cracked, it didn't crack quietly. It cracked with volume. It cracked with follow-through. It cracked with a kind of move that ends careers on the wrong side of the tape. That's what happened. Not hype, not a pump. $42 is gone. Welcome back to the macro mirror. In this breakdown, I'm going to show you why $42 was the most defended level in silver for the last 3 years, and why its failure matters more than any headline you'll read this week. I'm going to walk you through the pattern that keeps repeating every time silver does this, the pattern that separates the traders who get rich from the ones who get chopped up waiting for permission. I'm going to explain why the paper price can finally start moving when the physical market has been tight for this long, and I'm going to give you the 4 signals that will tell you whether this is the real move or another trap. Quick favor before we go further, subscribe, short and simple. If you want clean explanations when these structural moves hit, not hype, not cheerleading, just the mechanics, you'll want the notifications on. These breaks don't announce themselves in advance, and they rarely happen twice the same way. Hit the bell, and let's get into it. Now let's strip away the noise and go straight to $42. A technical level in silver isn't a line on a chart because somebody drew a line on a chart. A real level is a zone where the orders stack up over time. Sellers who said, I'll sell there. Buyers who said, I'll buy there. Stop losses parked just above and just below. Option strikes clustered around the number. Algorithmic models calibrated to defend it. When you see the same price get tested 3, 5, 10 times and hold, you're not looking at a coincidence. You're looking at a battlefield where 2 armies have agreed to fight. And when one army runs out of soldiers, the other doesn't advance slowly. It stampedes. That's what a real breakout looks like. Not a drift, not a grind, a release. Price moves through the level, pauses for a beat to see if anyone is going to defend it, and when nobody shows up, the move accelerates. Because every stop loss above $40 is now a buy order. Every short position above $42 is now underwater and getting a margin call. Every algorithm that was programmed to fade the level flips and starts chasing. The same leverage that held the level down becomes the fuel that launches it up. That's not a rally. That's a short squeeze in slow motion. And the timing of this particular break matters. It happened into a market where physical silver inventories at the major exchanges have been draining for months. It happened into a setup where the gold-silver ratio has been compressing from triple digits back toward historical norms. It happened while industrial demand from solar, EVs, and grid infrastructure grinds higher regardless of what the futures price does. In other words, the paper market finally let go of a level the physical market had already left behind. So here's the first lesson. In silver, levels don't break because sentiment shifts. Levels break because the people defending them run out of reasons to keep defending them. And when those reasons run out, the move is not gentle. Let's get more concrete. Because a level broke sounds like chart jargon until you understand what's sitting on top of $42. There are 3 layers of resistance at any major level in silver. The first layer is real sellers, physical holders, institutional desks, commercial hedgers who want to lock in a price. The second layer is technical traders, the crowd that sells every test of resistance because resistance is resistance until it isn't. The third layer is the structural shorts, the big players who are net short silver as a business, who have been short for years, and who need the price cap to keep their books from blowing up. When a level breaks, it doesn't break through all 3 layers at once. The real sellers get filled first and step aside. The technical traders get stopped out next and flip to buyers. But the structural shorts don't flip. They double down. They add to losing positions because they believe the level will hold because the level has always held. And then one day, it doesn't. And when it doesn't, they don't get to exit at the level. They get to exit 30, 50, 100% higher, if they're allowed to exit at all. Let me walk you through what that actually looks like inside the system. It's 3:47 in the morning in New York. A silver desk in Singapore pings the futures market with a modest buy. Nothing dramatic. Price ticks from 41.92 to 41.98. Then to 42.01. Then 42.04. The first wave of stop losses at exactly $42 goes off automatically. Retail traders who went short 3 weeks ago thinking the ceiling was permanent. Their stops become market buy orders. Price jumps to 42.15. Now the next layer triggers. Algorithmic desks that were programmed to defend the round number see their models fail and flip. They buy, too. By 3:52, a risk system at a major bullion bank in London flags a concentrated short position that was profitable for 7 straight quarters. The automated margin call goes out at 3:54. The trader managing that book isn't even awake yet. By the time his phone rings at 4:11 and his boss tells him to cover or post more collateral, silver is trading $42 or $80. By the time he can move the money from the treasury desk, it's 43.15. By the time he's closed half the position, it's $43.60. He didn't lose because he was wrong about fundamentals. He lost because the level broke at 3:47 a.m. his time, and by the time the humans got involved, the machines had already rewritten the tape. That's the mechanics of what you just watched happen on the chart. Now watch the chain reaction. Price breaks $42. Stop losses above trigger as buy orders. Those buy orders push price higher. Higher price puts more shorts underwater. Underwater shorts face margin pressure. Margin pressure forces some of them to cover. Covering means buying. Buying pushes price higher. It's the exact same spiral that happens on the way down during a margin flush, but in reverse. The same fragility that makes silver crash on rule changes is the fragility that makes silver surge when structure breaks. In futures, that spiral can represent hundreds of millions of paper ounces changing hands in a single trading session. Not because that much silver came out of the ground, because that many claims on silver finally had to find a new owner at a new price. Now, before we talk about what comes next, I need you to understand that we've seen this movie before. Twice. And if you know how it played before, you stop being surprised by what plays now. In the late 1970s, silver spent years grinding under a ceiling. Traders got bored. Analysts called it a dead metal. The financial press ignored it for entire news cycles. And then one day, the cap broke, and silver did more in 6 weeks than it had done in the previous 6 years. The move wasn't one rally. It was a sequence of level breaks, each one triggering more covering, more buying, more panic from the people who had been short the whole time. The story later got told as two brothers cornered the market. But the mechanics were simpler. A level broke. Then another level broke. Then the shorts discovered they couldn't get out. Silver went to $50. It didn't stop there because the world decided silver was worth $50. It stopped there because the exchange raised margin requirements 8 times in 2 weeks and killed the move by force. In 2010 and 2011, same rhythm. Silver cleared the old 1980 high, a level that had been considered permanent for 30 years, and within weeks, the next batch of multi-decade resistance fell too. Each break unlocked the next. The structural shorts, who had been comfortable for a generation, suddenly faced a vertical chart with no obvious exit. And when the move finally reversed, it reversed because margin requirements got raised aggressively 5 times in 9 days, not because demand vanished. The rally ended on a rules change, not a supply change. The people who caught that move weren't the ones who chased the top. They were the ones who recognized the first level break and trusted the pattern. And now, late 2025 into 2026, silver is doing it again. $42 was the multi-year cap. $42 is given way. The same pattern is setting up. The same structural shorts are in the same trap. The same physical tightness is underneath. The same industrial demand is grinding upward. Is that proof the move continues? No, I'm not here to promise anything. I'm here to explain incentives and mechanics, because incentives matter. If the market is heavily short by big institutions, and physical demand keeps draining inventories, a level break is not a local event. It's the first sign the structural short is losing control. That doesn't require a conspiracy. It requires basic human behavior. And when you're running a losing position and you've run out of ways to defend it, you cover. And when 1,000 people are covering the same trade at the same time, you get a squeeze. Now here's the part the official narrative doesn't want to explain. The stated reason the level held for so long was always resistance. Real sellers. Legitimate supply at that price. That explanation is partly true. Some of those sellers were real, but resistance and suppression are not separate things. They're the same action with different marketing. A market with heavy concentrated short positioning looks exactly like a market with heavy organic selling, until the shorts have to cover. Then you find out which one it really was. The big institutions can hold short positions for a long time. They have credit lines, treasury desks, and the ability to roll positions forward almost indefinitely as long as the regulators let them. Smaller traders can't. Retail can't. When the market starts moving against a concentrated short, the smaller shorts get liquidated first. The bigger ones get relief when the selling pressure drops. But if the physical market keeps pulling metal out of the system week after week, the bigger shorts eventually run into a wall they can't roll past. Delivery demand. Someone at some point shows up with a contract and says, I want the ounces. And if the ounces aren't there, the game ends. That's why $42 breaking matters more than a normal technical breakout, because underneath it, the physical story hasn't changed. Physical premiums have been firm. Warehouse inventories have been drawing down. Industrial users have been sourcing metal directly because the paper market wasn't reliable. The structure was already stressed. $42 was the last thing holding the surface calm. Now let's read today's action like a forensic report. The key clue in any real breakout is follow-through. Fake breakouts die within hours. Real breakouts hold, consolidate above the level, and then build. Fake breakouts happen on thin volume and get faded immediately. Real breakouts happen on expanding volume and don't give back the level when they pull back. Fake breakouts are followed by silence from the physical market. Real breakouts are followed by premium expansion, inventory tightening, and delivery demand rising. Here's what tends to happen during a genuine break like $42. Paper price clears the level. Headlines start catching up a day or two later. Retail begins to notice, but the real tell is what the physical market does next. Dealers start raising premiums because they can. Wholesale markets in Shanghai, Dubai, and London show prices running above the paper benchmark. Delivery requests on the major exchanges tick up. Warehouses report withdrawals exceeding deposits for consecutive weeks. That divergence, paper catching up while physical accelerates, is the signature of a real structural move. If the break were fake, physical premiums would stay flat or soften. Instead, they firm. That tells you something important. This wasn't a speculative spike. This was the paper market finally admitting what the physical market had been pricing for over a year. And here's why that matters for what comes next. A level break doesn't guarantee a sustained rally. It guarantees a transfer of ownership. Leveraged shorts get forced out. Leveraged longs from the previous range take profits. And the metal, both paper and physical, concentrates in the hands of the next holder. If the next holder is stronger than the last one, the move continues. If the next holder is weaker, the move fails, and you get a retest. So here's the cliffhanger. The break of $42 may not be the rally. The break of $42 may be the admission that the rally has already started underneath, and the chart is just now showing it. And if the physical market stays tight, and it will, because solar factories don't shut down because a futures price moved, and EV production doesn't pause because a chart pattern completed, the two have to converge. Either paper keeps running to catch up with physical, or physical availability tightens further because buyers rush to front-run the convergence. Both outcomes push price higher. Both outcomes hurt the remaining shorts. And both outcomes are the opposite of what the bearish narrative will tell you this week. You'll see the narrative attempts start within 48 hours. You'll read articles calling $42 a speculative bubble. You'll see commentary saying retail is about to get trapped again. You'll hear analysts say the move has come too far too fast. Ignore them. These are the same analysts who called silver overvalued at 15, at 20, at 30. They'll say it at 50. They'll say it at 100. Their job isn't to help you catch the move. Their job is to preserve the credibility of the system that's been wrong for 20 straight years, while the physical world quietly paid higher and higher premiums for real ounces. So don't let 1 week of headlines rewrite the bigger story in your head. Let it rewrite your understanding of the battlefield. Because silver is not just a commodity, it's a stress test of trust in the paper system. And every level break is the market admitting one thing without saying it out loud. When the physical world has been right for this long, the paper world eventually has to surrender. Now let's talk about fundamentals, because levels break for reasons, and $42 didn't break by accident. Silver demand is not a meme. It's embedded in the hardware of modern industry. Solar manufacturing uses silver for conductivity in every panel produced. Every gigawatt of new solar capacity pulls silver out of the system permanently, because once it's in a panel on a rooftop in Arizona, nobody's recycling it for 25 years. Electric vehicles use silver in power electronics, battery management, and charging infrastructure. Every EV built is silver consumed. Data centers, 5G infrastructure, grid modernization, advanced electronics, all of it consumes silver. And most of it consumes silver in small enough quantities per unit that manufacturers don't substitute even when price rises. Solar panels don't care if silver is $30 or $80, they need it either way. Now look at supply. Most silver production is a byproduct of mining for copper, zinc, lead, and gold. That means silver output doesn't respond quickly to silver price. Even if silver doubled tomorrow, you wouldn't get a flood of new mine supply within a year. The pipeline is slow. Permitting takes years. Capital expenditure cycles take longer. Ore grades are declining at most major producers. Geopolitical risks in key mining jurisdictions are rising. The supply side is constrained in a way most commodities are not. When consumption exceeds production for consecutive years, inventory absorbs the difference. Inventory has been drawing down. When inventory gets thin, the system becomes fragile. And in a fragile system, a level break isn't just a technical event. It's a trigger that exposes how little cushion is left. Add geography. Large portions of silver refining, industrial demand, and physical accumulation are concentrated in Asia. When physical metal flows east, it stops being available to satisfy paper claims in Western markets. If major Asian economies prioritize domestic industry and strategic stockpiling, and they are, global availability tightens further. This doesn't show up instantly in a futures candle. It shows up in delivery stress, in warehouse withdrawals, in regional premium spreads that widen and stay wide. This is why silver can grind sideways under $42 for months, while the structure underneath coils tighter. And this is why, when $42 finally breaks, the move is so violent. All the pressure that was hidden gets released at once. Now let me get practical about what this teaches you. If you were leveraged short silver, you just learned the most expensive lesson in commodities. You can be right about short-term price action for a long time and still get destroyed when the structure finally shifts. The market doesn't reward being early into a losing position. It rewards being correct about the direction the system is heading. If you're holding physical or unleveraged long, you just watch the market begin to validate what the physical signals have been telling you for years. The screen is no longer the enemy. The screen is finally cooperating. But here's the psychological war that comes next. The banks, the big shorts, and the mainstream narrative machine don't need you to believe silver is going back down forever. They only need you to doubt the move long enough to miss it. You'll see the attempts this week. You'll see articles about overbought conditions. You'll see warnings about retail euphoria. You'll see every effort to make you sell the move early before it matures. They will speak with certainty because certainty sells. But certainty at the start of a structural break is usually a lie. So don't anchor your brain to 1 week of price action. Anchor to the setup. Did $42 break because supply tripled overnight? No. Did it break because industrial demand collapsed? No. Did it break because the physical market suddenly had too much metal? No. It broke because the structural shorts finally ran out of room to defend it. And nothing has changed about the underlying math that made it break. If the setup is intact, the real question is not direction. The real question is timing and scale. Here are the 4 signals that matter more than any headline you'll read this week. 1. Physical premiums. If the paper price keeps rising and dealer premiums stay firm or expand, the physical market is confirming the move. If premiums collapse, the move is paper only and will fade. Watch what your local dealer is quoting. Watch wholesale spreads. Watch regional benchmarks. 2. Warehouse inventories. Look at registered silver in the major exchange warehouses. Are ounces leaving the system, staying steady, or being deposited back in? Net withdrawals during a price rise is the strongest confirmation signal there is. It means buyers are demanding metal, not paper. 3. Delivery behavior. On futures expiration cycles, watch how many contracts stand for delivery versus roll or close. Rising delivery demand during a breakout means the paper-physical arbitrage is active and real buyers are testing the system. 4. Regional price alignment. When Shanghai, Dubai, London, and New York start pricing silver differently from each other, arbitrage will try to close the gap. Persistent spreads tell you physical flow is dominating paper flow. That's the deepest signal the system can give you. Now I'm going to ask you 2 questions, and I want your honest answer in the comments. First, where do you think silver goes from here? And pick a specific number, 48, 52, 60, 100. Drop your price target and the time frame. Don't hedge. Commit. I want to see how this audience actually reads the setup. Second, when paper price and physical premiums both rise together, which signal do you trust more? The chart or the price your local dealer is actually quoting you today? Answer both and read what other people are writing. You'll learn more from the comments on this video than from most analyst reports this month. Now, what should you expect next? Expect volatility. After major level breaks, markets don't just go straight up. They test. They retest $42 from above to see if it now acts as support. They shake out weak longs who bought the breakout without conviction. They punish anyone who thinks one day of price action means certainty. Expect narrative attempts to shake confidence. You'll see them everywhere. The job of those attempts is not to inform you. It's to make you question the move long enough to sell too early. And expect opportunity to appear exactly where fear is concentrated. If and only if the physical signals stay firm. That's the filter. Not price, not headlines. The physical signals. This is where patience becomes an edge. Because most of the audience watching this market is emotional, oversized, and reactive. They buy the top because the move feels safe only after it has already run. They sell the first pullback because the chart feels like pain. The disciplined holder does the opposite. The disciplined holder watches the structure, not the candles. I'm not telling you what to do with your money. This is education, not personal financial advice. Your situation is your situation. Your risk tolerance is yours alone. But I'm telling you what just happened. A level that mattered for years just broke on real volume with physical confirmation underneath. And structural breaks like this are where silver separates the people who understand the game from the people who are playing it. Amateurs think price equals truth. They wait for confirmation from the same institutions that were wrong the whole way up. Pros know that price can be suppressed by structure for years, and when the structure breaks, the move is where the years of suppressed energy finally release. Silver is a small market. That's its weakness on the way down and its power on the way up. In small markets, it doesn't take much concentrated selling to crush the price. And it doesn't take much sustained buying to send it vertical. That's the nature of the metal. That's the nature of every silver cycle. That's why when a level like $42 finally gives, the move that follows is rarely small, rarely quiet, and rarely the kind of thing you get a second chance to catch. So here's the clean summary. Silver just broke $42, a level that had capped it for 3 years. The break came on real volume, with physical confirmation, into a structurally tight market. This was not a news event. This was not a sentiment shift. This was the paper market finally catching up to where the physical world has been pricing for a long time. The move may test. The move may consolidate. The move may even briefly retrace. But the structure that defended $42 is gone, and it does not rebuild easily. And the signals that will tell you whether the next leg is coming are physical premiums, warehouse inventories, delivery behavior, and regional price alignment. Not the headlines, not the analysts, not the noise. This is where the serious holders of silver separate from the tourists. The tourists watch price, the serious holders watch structure. And right now, the structure just shifted. If you want the next breakdown, the moment the next level breaks, the moment the next signal flips, the moment the narrative tries to reverse, subscribe. These moves don't come with warnings. They rarely happen in isolation, and they never announce themselves on the channels that are paid to keep you looking the other way. Hit the bell. Drop your price target in the comments. Tell me whether you trust the chart or the dealer, and I'll see you in the next one.